A fair value area is not just a swing point, it's an area within the market. In an uptrend, these areas are usually classified as fair value areas because they encompass your mitigation block, breaker block, and order blocks. Swing highs in an uptrend can also be regarded as fair value areas, but only when they overlap with a fair value gap. Now, in the example I shared yesterday, that entire region was considered a fair value area because it contained both the order block and the mitigation block. However, that fair value area could also be refined to the swing high since it clearly overlapped with a fair value gap. And not just that, there was a strong rejection right at that exact spot. That was the main reason the trade was taken. Now, at the current price, we can see that price has created a new fair value area, which includes both this swing high and this order block. However, for this swing high to be considered a valid fair value area, it must have an overlapping fair value gap. That means we need to wait for the next candle to close before confirming whether a fair value gap has actually been formed. Here we can see that the candle has closed, and this action created a fair value gap. Notice how price immediately returned to that area, rejected it, and then started pushing upward. After price continued higher and broke above the previous higher high, this region now becomes your new fair value area. But this particular swing high would not be considered a fair value area, simply because it doesn't have an overlapping fair value gap with it. And as you can see, the moment price reached that zone, it completely disrespected it.